Hi, today I'm going to speak about commodity price risk management and our rising need for Indian gold jewelry manufacture to protect and preserve. Gold is viewed both as commodity and currency. This leads to volatility of price during the time of uncertainty. India is the second largest consumer and not a producer. That's why it relies on import. This since Indian gold jewelry manufacturer market is highly scattered and unorganized, it resulted in limited awareness of price risk management. In India, firms often tends to make some structural faults while applying hedge strategy, like fail to examine how hedge would perform, both upside downside scenario, too much proportion to hedge, and this indicates a rising need of price risk hedging in gold jewelry manufacture sector of India. Now, what's the objective of my papers? To analyze what factor in the industry has a significant impact on companies' price risk, to examine why it is necessary to be aware, what sources are the best for the information on gold price risk hedging and the market, to give interpretation on topics related to commodity price risk management and how a hedge strategy should be applied using future contract to protect and preserve. Now let's go to the literature part and see what the people have said about it. Butcher 13 in 2013, he in his paper talks about gold standard history, its exchange history, and about the factors affecting gold price. COEX 2018 in his paper talks about evaluation of risk management, a rising necessity to use to protect institute risk. Deloitte Max MCX India 2018 MCX 2020 in the article talks about Indian commodity market, its necessity and its application. World Gold Council 2010 in their paper talks about how gold is an important commodity and suggests it as a potential diversifier at the time of uncertainty. Bole and Makundan's paper critically analyzes the efficiency future market and tells how future market helps in efficient price discovery. Nanavati 2017 in Economic Times states that gold jewelry manufacturers needs to protect their price risk through hedging on the cost in future market. But first, owner of gold jewelry manufacturers should need to improve their awareness about hedging commodity derivatives through educational institutes, seminars, investors' experience, and every available means to take advantage of. Now let's go to the methodology of the paper. The methodology of the paper is divided into three parts. The first part is used ontology as a philosophy and constructivism in it with an induction approach. The second part is I'm gonna show the facts and evidence about the recent event that suggests my objective, and the third part is interpreting data, yeah, and showing a case study from MCX brochure. Now let's go to the fourth part of the paper: data analyzing, examining, and interpreting. Part 1. In this part, we're going to analyze data of gold price, supply demand, volatility from 2010 to 2020. The three major events here is European crisis 2010 starting, Russian financial crisis 2014, black box, and COVID-19, the present 2019-20, the blue box. Event 1, gold. Now if you see, and now let's come to what happens in the first event during European crisis. In first event, gold volatility increased by 1.5% as seen in figure 3. The situation resulted in increase in gold price by 15%. Supply has reportedly seen increasing every year as is shown in figure 2, and demand has been seen decreasing in jewelry sector but increasing in investment sector. Even 2, gold volatility has dropped by 4% at the time when crisis hit, and price dropped by 10%. Here, the demand of jewelry slightly increased, and the demand of gold investment has also increased. The supply of gold has still been increasing, and as demand is high. Event 3, gold volatility has inclined up to 7%. The gold price has inclined greatly by 60%. The demand for investment gold in gold is at its peak, inclined by 90, and the demand of gold jewelry has been affected a lot and has declined by 70%. Supply has been decreasing as seen in the first quarter of 2020, which is only 1500 tons. Now, what does the study indicate? Not all crises have the same effect on the prices. Gold jewelry sector is in low correlation with price, which means both the variables are go downs. I mean, when the demand grows in low correlation with price. It's like when the price goes down, the demand increases. The price goes up, the demand decreases. Gold investment sector demand is in high correlation with price. Gold price is in high correlation with volatility. Gold demand for jewelry is in negative correlation with its supply, and gold demand for investment is in positive correlation with its supply. Since India relies on import for gold, its industry is very much exposed to price risk. It is also seen that gold has been considered as a safe haven commodity at a time of crisis. Even when the price of gold goes up, since India's major demand is for jewelry, it has become necessary for the manufacturer sector of gold jewelry to hedge their output through future contract to protect their company's risk and others' management risk. Now let's go to the part 2 and first see why is it important. Why is it important to be aware and what are the events here? So risk management is an old concept. Let's go to the history. It's predated 7. And before, risk management was just about protecting the insured risk. But after World War II and further crisis, price risk management concept has changed. Now it is used to protect both insurable and uninsurable risk. Commodity market in India is still at developing stage. The market is fragmented and scattered, due to which there's a lack of awareness of roles and techniques of commodity derivative. And that's a major issue in the mid-level manufacturers, as been seen in M6 2018 article. Gold price fluctuates a lot. It's high volatility and a profitable asset. It is here. MCX and COMEX is affected by significant factors like rupee dollar equations, then geopolitical factors, increasing volatility, supply demand volume, weakening of dollars, inflation, future demands, crisis makes Indian gold jewelry to export too many risks in international and in domestic market. Mudgil in 2020 recently seen and stated in the article that Titan, India's biggest gold jewelry manufacturing company, did a hedging loss of 40 million. And here he states a very important fact: to not to hedge more proportion, like not commit maximum proportions, and because sometimes it could lead to hedge effectiveness and hedging loss. And here what happens, Titan hedged their whole output for in the future market, but since the anticipated sale went wrong, they made a loss. Now these all things indicate that Indian businesses in India, jewelry businesses in particular, are exposed to many price risks at the time of instability. Makes it necessary for Indian firm to apply hedge strategy that would help the institute to protect their gold cost volatility to the future market, in order to protect their portfolio and price. And before applying it, understanding it is very important. And in the next below side section, I'm going to show you the institute from which you can get reliable and information about it. Now, it's not that there's no source in India. It's just like people work in traditional way in India, so that's why they are not They don't rely on many online information. So yeah, my objective of this part to give them proper in, information about institutes who are responsible to these strategies and who are responsible for the gold jewelry market. First, the International World Gold Council, organization responsible for the development of gold industry. LBMA, London Bullion Association, Market Association. It's an important benchmark used by COMEX for price discovery. Then COMEX, divisional responsible for metal trading internationally. Now come to the domestic market, India. MCX, responsible for commodity derivatives and all commodity trading in India. GJPC, Gem and Jewelry Export Promotion Council, responsible for the development of gem and jewelry industry of India. Other than institutional sources, firm could also get knowledge from attending, creating seminars, webinars around the topic. There are always some seminars going on related to the industry. One could get information about these seminars to the on the Above Institute respective website. Firm could also hire experienced hedgers that could perform the strategy from them. Now let's go to the part 3, the interpretation. Commodity price risk management is a very important concept and is dependent on many variables. So before applying it, one's need to understand every variable of it, like risk appetite, corporate treasury, its methodology, price volatility, supply demand, crisis effects, and everything. Now, what is commodity price risk management? It's Commodity price risk is a risk on company's financial position and its portfolio. It has become important for the entity to manage its financial performance as volatility has a significant impact on commodity price. In case of gold, it makes companies' price exposed to margin risk and other financial risk. Now let's see the methodology of the hedging strategy. First, analyze the exposure to the correlation to the price. Second, analyze firm's financial and strategic strength and its exposure to risk. Third, analyze price pattern and market situation to predict its future. Fourth, price risk hedging, trade and volume and its arrangement. Fixed price of hedging, trade, volume and its arrangement. Fifth, execution of hedge strategy. Sixth, track performance to assess hedge position. And assess hedge position for future consideration. Now, now the next part. I'm going here in this part, I give an interpretation of case study of gold box from the article Gold Hedging Brochure by M6 in 2020, page 4. This strategy is in relation with jewelry industry, particularly in India. Now this was situation. 5th July 2019, Union Budget of India was going to be announced by the Finance Minister, as said in Indian Today 2020. 3rd July, the price of gold was 33,000 Indian rupees, $440 per gram, per 10 grams. The company owner analyzed that since gold price is highly fluctuating, it is possible that announcement will have a significant impact on gold price, and this is what he analyzed. The sources from his side indicated that there could be an increase on import duty, and increase in import duty suggested owner that it would be increase in supply, and since supply is in positive high correlation with price, the price could also go up, but there is a chance the price to decrease. What's the owner's action to do? The owner decides to buy 20 kg of gold from the bullion market at the rate of 3,300 per gram and sell it to future market for 3,350 per gram to MCX. Parameters to be understood. Owner needs to hedge, not speculate. Understand both downside, upside scenario of the price, and companies should reach their objective under their risk appetite. Risk appetite is company's strength and in finance and operations. So a perfect application of pricing management strategy is when firm reach their objective under their risk appetite. or the capacity of the firm. Now, this could possibly work in three ways. At the time of delivery, the gold price shoots up. The so s- though he sells it for 4,000 a gram, but he'll still make a loss because he had already hedged his contract. So he has to give the difference, which is 3,300. 4,000 minus 3,300 and 700 rupees a gram to the contract. So yeah, he just protected his cost. Second situation, at the time of delivery, the price gold shoots down, says to 3,200 the rupees per gram. Manufacturer will make benefit from the future contract of 150 rupees, but its selling price will still be like 3,350 per gram. Cost, sale price. At the time of delivery, if the gold price remains the same, the owner will benefit from the contract of 50 rupees per gram. That's 3,300 minus 350. Owner will sell it for 3,300 per gram, leaving it the net sale price as 3,350 per gram. In all three cases, the firm is able to protect its price by using future contract in commodity prices management. This is what happened really at the time of budget. When the budget was announced, the price went up to 3,700 since the owner had already hedged his contract, hedged his output. He didn't make any loss, no profit. He just protected and preserved his cost, which is very important. Now let's go to the last part, the finding, recommendation, and conclusion. Events mentioned in part 1, the poster has a significant impact on price discovery of gold. Indian markets are exposed to too much risk. This indicates use of price risk hedging to protect firm price and portfolio. Awareness of hedge strategy is necessary before applying it. Manufacturers should hedge their output to future market, which is preferable to protect cost. Firms should avoid speculation. Speculation is gamble and should be avoided at any cost. Recommendation: this research could be used for mid-level gold jewelry manufacturers, new entrepreneurs study, and since Indian market is still at developing stage, it is not much written on Indian commodity derivatives. Gold jewelry industry should focus on protecting its price to future and not speculate it, which is very important. Commodity prices should be applied by gold jewelry to protect their company's way, and it's important. And this is now going to be a future. Since COVID-19, we can see the risks are increasing, and people need to protect their risk in order to stay in the long run. Now these are my conclusion. Now what's the conclusion of this? Commodity pricing management in gold industry has become a necessity, and before applying it, people should know about it properly. And the sources above are the perfect way to get to know about information on anything about the about topic. The author thinks there's a lot of strategy. I think there are a lot of other strategy that could be applied. Future is contract is the most preferable one, but there are more other contracts that have been introduced in India, like option. So for further information, you can go to my cited articles. You can email me if you want the articles or the whole document on it. I would like to thank the university, my module leader, my dad, various friends and families who helped me during this project, giving me guidance about the industry. I would like to specially thank MCX and World Gold Council for helping me, giving me articles on it. Thank you for the print. Thank you so much.